Hello, folks. This is Brandon Chapman with you. It's another TheoTrade video for Monday, July 28th. And as we're about 25 minutes to the market close, the S&P is down about 0.2%. And coming off some major move over the last several months, we're kind of at a point where there's a lot of stuff that could create some degree of risk this week, namely the FOMC policy statement on Wednesday. We've got Microsoft earnings on the 30th, I believe, right here. We've got Meta earnings. We got a lot of the Mag 7 names on July 30th. We got Amazon coming up, AMZN, and that's on the 31st. Apple, what do we got there? Apple also, if we look right here, for example, on the 31st. So we've got, four of the stocks from the Mag 7, which represents a significant amount of the S&P 500 earnings. And if we look at Google, for example, how did Google fare? Good numbers, not exactly rewarded for it. We look at Tesla. Not so good numbers, big gap down. We're kind of making some of it back here. But again, we've got Microsoft, again, coming up this week. So we've had a couple of a mixed bag in terms of earnings reports, but Microsoft is a stock that's up dramatically. We've got Amazon up dramatically. Is there some downside risk, even if the numbers are good? If we take a look at Google, certainly suggests that may be a possibility. We're just not going to get the benefit if we beat, but if we miss, we could see a large decline. And couple that with the fact that the Fed is announcing on Wednesday, right? They're making their policy statement. We got a lot of stuff going on. And of course, August 1st, what's going to happen with China and the tariffs? Man, there's a lot of stuff going on right now that, again, could create a significant amount of volatility. Point being, as we go back to the S&P 500, any positive news this week may not be received quite as positively as the negative result to negative news. Now, as we consider these possibilities, what are institutions doing in the face of this? Well, if we look at the SKEW index, we did see a big decline on Friday from about 160 down to 145. But just remember, 160 is like nosebleed levels historically. 145 is high. So we have a significant degree of hedging on the part of institutions. Generally, the trend's been up since April. Again, a big tick down, but again, we could see it go up today. The VIX, though, the market's down a little bit here, but the VIX is up slightly. Probably not going to see much movement in SKEW, but we could. Likely to the upside rather than down. We'll have to wait to see after the close today. But we know that there's been a lot of hedging. We know the VIX is testing low levels. And as we look at forward volatility, future expectations of volatility, we just came off the highest level on the 3-month to 1-month VIX. Basically saying what? The 3-month VIX was about 1.22 times greater than the spot VIX, 22% more. That's the highest level we've seen since going back to December 3rd. The previous times we've crossed that 1.2 Rubicon was on the 24th of December, Christmas Eve, and on February 14th. So again, the market is pricing and institutions are pricing in a significant degree of volatility in the near future, commensurate with February 14th, December 24th, and November 31st. You could go back to August and September as well. This has been a pretty timely indicator. It's the first time we've gotten above and it closed where the 3-month VIX is 20% higher than the VIX. So what's your response? If you own a stock, like I'll pick some stocks off my Ghost Prince Industrial and Technology watch list here. You look at stocks like, for example, today, SIDU is down 40%, and it's not even in earnings. We've had other stocks spend 20, 30%, stocks gapping and selling off, giving most of it back. The reality is most of these stocks in here, Rocket Lab, for example, this stock could be down 30% tomorrow. The fact is these companies are way more volatile than what their beta suggests. This suggests only 2 times more volatile than the S&P 500, and yet its 30-day implied volatility is about 92%, while the S&P 500 is at 15. This stock could easily drop 5 to 6 times more than the S&P 500. So how do we reduce risk in these names? You're probably not hedging them individually, and if you do a portfolio level hedge, guess what? It's probably going to be unsatisfying because while the S&P may drop 5%, this might be down 50%. That's the reality of where we stand right now, right? Stocks that have been up a lot through short squeeze and retail trade, This weak hands buying will eventually turn to weak hands selling, selling at market. A lot of the companies over here, as you kind of scan through this list over here, could have big down days as well as big up days. When do you sell? But today, nothing's really surprising or popping. Tesla's up 3% after its big sell-off. The surprises are much more on the downside, and we have to acknowledge that there's significant risks in a lot of these names that have benefited by a short squeeze over the last few months. So once we take profits in these stock, and you might try to raise about 30% cash by taking profits. Notice I didn't say losses. Taking profits in names that are highly volatile. You might consider hedging some of your directional risk if we're talking about a portfolio that's pretty correlated to the S&P 500 and has risk commensurate with the S&P 500. Well, what can you do here, right? Well, buying puts as a means of reducing risk. And I showed this during my session earlier today for the S&P 500, or the SPY, for example. What can you do here? Well, we simulated doing a $100,000 portfolio, 157 shares, times 60 of 635.93, we get $100,000. Well, that's 157 delta, right? We want to shave about 30% off of that. Well, that gets you close to 50. So we bought two 30 delta options in here, put options. So if we go to simulated trades, what you'll see is we went out about 30 days, in this case, 39 days, and we went in here with around a 30 delta at 624. We've kind of moved around since then. At 621, was that the 5 step? Yeah, at the time it was 621 in here. That has a 27 delta now. But again, 30 delta right now, you buy a 624, buy two of those if you have a $100,000 portfolio. Well, that's going to cost you right now about $1,100 to buy two of those. $570, about $580, $580 per contract, two contracts. Well, I want to sell something to be able to pay for that. So we go on the call side and we kind of scroll out here to around a 40-ish delta. 39 deltas is 646, 41 delta, 645. Again, we've shifted a little bit. So now this delta is about 42 delta on 644. So any one of these works. For the 645, you could sell the 645 and buy $6 out of the money. Notice where that puts us. It puts us out here, 650, 655. So you move it down a strike to 644 and buy the 650. That earlier today was yielding about $2.60. So you sell four of those, you buy two of those, virtually offsetting the risk. Now, what does this do to our return? Well, if we look at the price slices here, given a plus 10%, minus 10%, we see a 10% decline. We're down $269. $269, right? Well, if we go up 10%, we don't make 10%, we don't make 10,000, but we make 7,600. So the idea is we give a little bit of upside away for eliminating most all of our downside. This is a way of taking a hedge on your long stock portfolio. First step is always considering taking profits. So if you go from 100% exposure, you pair that back to 70% by taking 30% of those in gains, in profits, and taking some risk off the table. Then you look to hedge. So we go from 154 delta down to a 63, and effectively you've neutralized your portfolio delta quite significantly. Now, how do we manage this? It's really simple. If the price of the market drops down here below 621, well, guess what? That is our long strike at 621. We sell 621 and we buy one out of 30 delta again, right? We still have our hedge, but we have a chance of taking out about $1,000 in profits on that put. At that point, we're probably in a reasonable position to close out this spread here for about 10%. Maybe it costs you 25, 26 cents to close out each spread, or $26 per contract, or $100 to shut down the call spread. And we now have a put that's down here that's continuing to hedge, and we've removed some of our risk. We had a client here just send me some of his rolls that he did back here, took out about $50,000 during the sell-off in the market right here. And again, and that's cash that he's booked that he can later deploy as a hedge or other means. And again, all of a sudden the market takes off and you've captured all the upside and you've reduced your risk maybe 5 to 10% of that 20% sell-off. That, my friends, is significant. Plus, you have a 30% cash position. You have a chance to deploy capital as the market sells off. Now, do I know what the market holds? No. But I do know is that, look, it's likely that we're going to see any positives that come out this week. It may not be received as positively as any negative news. And anytime you have this imbalance or skewed relationship to the market, this is where you need to consider starting to book gains. And in these kind of stocks over here, like a QuantumScape, for example, it's gone from $4 to $15 down to $18. If you're not going to take profits here, then when? Right? Are you going to wait for the bigger decline here, right? We go from 275 to 460 in Virgin Galactic's. Not the fundamentals have improved. And previously we hit 650 before going down to 279. If you're not going to take profits here, when? We could be down 40% tomorrow. And we have earnings coming up. This seems like as good a time as any to start to take gains in the stuff you have big gains in and start to hedge some of the stuff that has moderate risk that's more aligned with the S&P 500 in terms of volatility. Maybe it's 1.5 or 2 times more volatile. That's something you can hedge. And another thing we talked about here at TheoTrade, hedging using the VIX and other ways. But what I just showed you with the SPY is assuming you have a portfolio that's relatively correlated to the S&P and provides a pretty reasonable means to reduce downside exposure at just this point in time when the VIX is low, SKEW is high, and we're seeing that vol expectations are extreme. Again, if you're not going to hedge now, if you're not going to take profits now, when? If you wait for the correction, guess what? It becomes a lot harder. And you might suggest it's too late to do this kind of strategy. You're going to have to come out of pocket, maybe buying in the money put or do futures or doing put spreads. And then it becomes more muddy or messy. All right, folks. So again, big takeaway is we have a lot of events this week that are creating risk. Again, acknowledge those risks, look to book profits and reduce exposure through hedging if we get a correction here. And so again, we'll see what happens. I'll catch you back next week and we kind of recap how the week went and how the hedge looks next week. Anyway, it's been a pleasure being with you. We'll see you back next week. Thank you.